Hey everybody, this is Jose Blasco. We are about to get started. This is a sound check. Please, as always, go ahead and type a quick hello on the chat box so I know you hear me well. And that will tell me that we're ready to get started, which should be the case. We can always appreciate it to have this extra confirmation. So I'm just gonna wait for a quick hello. I'll position myself in the bottom right side of the screen in the meantime. And just waiting for that confirmation so we can begin. Thank you so much, Joe. Thank you very much. Very nice. So ready to get started, everybody. I just double checking everything. Everything is good. Perfect. Welcome to the session, everybody. Today is December 17, 2021. My name is Jose Blasco. This is Options with Options. Obviously, the name of the session says it all, isn't it? We are here to trade options. We are here to analyze the markets, look for options opportunities, put them together, discuss how the strategy work, etc., talk about parameters, rules, and put those trades in place. Before we get started, a disclaimer on the upper left side of the screen. Read it carefully, please. This is important information. I am counting on you to read it completely. How are you, Mark? Good to see you. And now that the disclaimer has been highlighted, I would like to highlight the agenda, which is a review of the market, review of trades that we have running at the moment, and from there we'll be looking at new trading opportunities. So let's begin. And a quick message before we start. Actually, I wanted to say a quick thank you for you guys being flexible with me this week. The session that we were supposed to have yesterday was rescheduled to today. So that was something that is not common, but it had to be. And I appreciate you guys joining me today live, or if you're watching this recorded because you could not do it yesterday since the session was rescheduled. So again, thank you for your flexibility and understanding. Thank you so much, guys. Anyway, let's jump in the platform and let's begin our analysis, okay? So here is top. Here is the S&P ETF. The market open gapping down 1 point something percent today, isn't it? Right inside of a green UFO, and from there, pretty impressive movement to the upside out of that UFO in the 55 in the time frame, okay? But, you know, let's get deeper into what we have, okay? Apart from an intraday move that we can see on the chart on the right, let's understand better market conditions. So from a market condition point of view, you can see that right now we have a non-confirmed climate, okay? We are in a non-confirmed climate situation. The dot is blue, but the dot is thin. It's not a thick dot, and therefore the climate is not confirmed, and that means that betting on one direction or another, long or short, carries limited amount of odds, which if you were to trade like me, you would assume that it's not worth it to take a trade in any specific direction at this moment in time. Okay, so a different story is, so what if you have a portfolio? What if you have multiple positions? Are you going to hedge? Are you not going to hedge? Maybe to hedge, you need to enter a new position, and you enter a new position as a hedge. All of those things, of course, make a lot of sense. But when it comes to betting hard and having a portfolio loaded on positive delta or negative delta because you expect the S&P to do something, well, right now, statistically speaking, there is not. We don't know what to expect. That's what basically the conclusion of a non-confirmed climate. Therefore, betting too hard on positive or negative deltas will not be the best choice. Okay, from that statistical point of view. In any case, the fact that the market has been dropping has created an increase of implied volatility. So volatility is currently trading at 21.5, which is a little bit more spice compared to prior days. And in this sense, we're going to be looking at iron condors and trades of that sort to sell premium and profit from time passing and the markets to remain sideways or range bound within a range, even though the range may have an angle to the upside or to the downside, and profit from that. Because again, if the market is not clearly defined with a non-confirmed climate, so again, it would, I guess it's common sense, it would not make that much sense. Okay, cool. Now, talking about what may be happening into Monday, look at what's going on right here. We have a pretty big contradiction, to be honest. When we look at the volume map for the S&P, we can see 1.3 times, 1.5 times, 1.1 times, 1.3 times more calls traded than puts. And you can see, especially on the one that expires today, that the calls are reaching their 5-day average, where the puts are not. And on the other ones, both calls and puts are reaching their 5-day average. So in other words, 1.3, 1.5 starts being interesting, but 1.3 doesn't mean too much. We are seeing the volumes to reach volume averages both on the call and the put side. And on top of that, we can also see how today, real time now as we speak, the implied volatility for the calls and the implied volatility for the puts, okay, happens to be almost exactly the same. Exactly the same, 17 and 17. Okay, so a great amount of indecision at this moment in time in the marketplace, which again can be seen easily with a thin dot in AutoClimate. Okay, now this is today. If we look at the 1.3, not the 1.3. If we look at the 3-day average of the implied volatility, notice how the puts are trading at 16 volatility, the calls are trading at 14 volatility. So if I was to bet on something, is some sort of a bearishness, and probably this climate will change to red on Monday, and a couple of days of movement to the downside could be expected into the middle part of next week. I guess we'll talk about it when we meet again next Wednesday. But yeah, so that's what we have at this moment in time. So again, from different angles, while there is a little bit of a component that suggests bearishness, again, everything else it's pointing at unconfirmed, and therefore a note of caution it's for me to mention, so you guys are safe. Okay, Joe, is the 1.5 the threshold to buy? Yeah, 1.5 basically it's the minimum for us to conclude that there is some sort of an imbalance where either the calls or the puts are winning. Okay, that's the minimum. Actually, even when we look at the matrix in top, and you are scanning for volume situations, notice that here you got the 1.5 value. So anything greater than 1.5, of course, the greater the better. Anything above 1.5 represents an imbalance. And an imbalance means either the calls are winning or the puts are winning, meaning you have odds on your side of being a buyer if the call is winning, odds on your side of being a seller if the puts are winning, as a generic statement. Okay, but really the way I'm diverting a little bit here, but the way I like to combine this, and I would like to suggest that you guys think about it, is to, for example, select imbalance 1.5 for the call. Okay, and you can look at the current month or the next month. I'm going to look at the current month, and so again, if you want this to be bullish, okay, together with that, you can then add the top positive CIV spread, because this is going to tell you that the volatility of the call is greater than the volatility of the put, together with the fact that 1.5 times or more calls are traded on the put, and the volume is above the 5-day average. So all of this is now giving you a very, pretty powerful bullish sentiment, which is building up in the options arena. If you don't use that, okay, and you leave it like this, so now yes, you have 1.5 times more calls traded than puts, but they may be sold, and selling calls is actually bearish instead of bullish, right? So you never know, and that's why it's a good idea to combine it, and that's why I got in the chart here the indicator with the volatility comparison, both on my chart on the left as well as right under the volume map, so I can see that real time. I also have the 5-day average. Okay, so normally I work with the real time and the 3-day, but if in doubt, I can always go ahead and take a look at what's happening in the 5-day average as well, and that way try to understand. You never know for sure, but because different strikes may have a different behavior, but try to understand if those calls are being bought or sold, or those puts are being bought or sold, and therefore the bullish or bearish sentiment which is building up behind the scenes. Okay, good. Okay, so we got that when it comes to market analysis. So again, not too much more to say. We are just gonna position ourselves non-directional today in the session. And then from a positions point of view, okay, so if we look at what we have, so one of the trades we have is COF. which, if you recall, because again we haven't met for a few days now, so I want to recall. So we started this, selling puts and buying calls. Then we closed the puts and we created a bull call spread. Okay, that was for a net credit actually, even though it was a bull call spread, so you could not lose money anymore. And then we became a bit skeptical on this trade, and then we butterflied it. That's the last thing that we did. Okay, so if we look at COF, okay, and we look at COF, okay, this is the time frame we were using when we planned the trade. So you can see how that stock, has had some reaction to the speed bumps, but in both cases then it went down, okay, and now down again. So good move, in our case butterflying it, because again, instead of being in a situation where we didn't butterfly it, and then the most you could lose would be, actually the most you could, the least you could make is 26, because you could not lose anymore. That's when we converted this into a bull call spread. Well, when we butterflied it, okay, so those $26 of minimum profit became $58 of minimum profit. Okay, and the current price of the stock is right here. So this is where the stock is trading now. If the stock remains, somewhere in here, so we're gonna make 58. We just need to wait until January 21st, and we'll make $58 net per contract. But if that stock was to rally and reach our target, ideally 179.4 is the midpoint. So 179.4. So you could make so much more, okay, close to $500. But again, that would also depend on how much time has passed when you get there. So far at this moment in time, we are almost in a not almost, we are in a sure thing profit of $58. We'll see what happens from now until January 21st. Maybe we make more, maybe not. Okay, so we'll be discussing that, but there is nothing else to be done in this particular trade. We just leave it alone for now. The next trade that we need to comment on, which this one is also going to be a very short comment, is Yelp. Yelp is utilizing February 18 expiration. Okay, so this is a trade that is not working well for us. Okay, so we took this trade. Wait a minute, I have it here on the intraday time frame. Here we go. Yes, so this is the day when we enter the trade. Okay, right here, and notice how since we enter the trade, we are underwater all the way, all the time. Okay, now while we are underwater, almost all the time. So what we did with Yelp is that we butterflied it. We went from a bull call to a butterfly, and then if you look at the risk graph, so of course if everything continues the way it is, okay, then we're gonna end up with a maximum loss of $300 per contract, which is good because the initial loss was more like 400 plus, I believe. But now if that stock rallies back up and just gets above 38.2, okay, which is not that far, to be honest, it's right there. Okay, so as long as that stock rallies, so we are going to be back in business thanks to this butterfly effect and having lowered the risk of the trade. And we got until February for this to happen, so we could certainly end up with a profitable trade here, even though at this moment in time, temporarily, it's showing a little bit of red. And finally, the last one I have to review for us today is Facebook, which that is a trade which is over. And I'm sure you guys had fun with this trade because we had two conversations about Facebook. I should say Meta. I just don't get used to it, especially since the ticker symbol is FB and that will not change. So, but anyway, how many of you were in the Meta trade, guys? Let me know how many of you were in this trade, because for us to be profitable, we just needed to end up expiring below the red line, and that was right here. Okay, this is where we expired, which is right under the red line. Okay, right there. So that's why I'm saying it was quite fun, because it was indeed quite challenging. So the trade ended up with a full profit, but let's face it, there was a component of smart luck, if we can call it this way, but that's what it is. Okay, so we were counting on the UFOs that were present, if you recall, that area between the red line and the purple area, okay, had multiple. I don't remember if it was one or two or three. I don't remember now. I think it was two. But basically, those UFOs present in that area, we were counting on those UFOs to either slow down the movement to the upside or ideally bring the stock price down to the purple zone, because the purple zone was the profitable area. Okay, the purple zone is the zone between the red lines. Okay, and that's where we are profitable. So as you can see, so price went higher, came back down, came back higher, came back down, and thank you, Mr. UFOs, okay, because you helped Meta to go back into the purple area, and therefore we ended up with a full profit. Okay, for sure. The actions taken in this trade, as we discussed before, would have been different if instead of using a 1 week expiration, we had used multiple week expirations, because we could have started to roll, including smart luck. I love it. Thank you, Christian. So we could have used rolling techniques. Okay, we could have done our tweaks, our usual tweaks, right, all the way to converting the trade into an iron butterfly. But when we did the analysis of doing that, because it was only a 1 week expiration, so the benefit was not really justifying it, isn't it? So then the decision that I took during the session, and all of this, if you were live with me, if not, it's all recorded. But basically, the decision was to leave it alone and just trust those UFOs to bring price in. Okay, and in my case, I didn't wait until the expiration time. I had a limit order. If you recall, I placed it during the session. So I didn't make the full profit of, I believe it was $112 of credit per contract, I think it was. I made less, but because I was filled somewhere in the middle of the day, I didn't wait until the very end. But the reason why I got filled is because price went inside the purple area during that day. Okay, if price had stayed outside the purple area, then I would not have been able to get filled at the price I was asking. I should say the price I was bidding, and then I would have ended up with a loss. Okay, so that was tight. Okay, my friends, that was very, very tight. But I guess that was a very good experience. And indeed, the type of things that happen in real trades. And when that happens and you are looking at it by yourself, you may get a bit anxious, a bit nervous. So hopefully all the discussions that we had, helped you to manage it. And indeed, I'd love to know more about the ones of you that were in the trade. How did you end up with? I remember a few of you exited ahead of time when it started moving away. Fair enough, as long as if this is part of your trading plan. But yeah, Christian, I'm with you. Okay, I hate not being able to tweak in a 1 week iron condor. I get you. There are many ways on how to approach options trading. Certainly, this trade was very simple because you sell the iron condor, you leave it alone, and that's it, right? So it's very simple. That's the beauty of doing these very short-term iron condors. You're right or wrong, and that's it. But if you're an options lover, and I know you are, Christian, and probably all of you, indeed I am. So when you are an options lover, typically you like to have a few more choices. The name of the session is Options with Options. So typically we like to enjoy different alternatives and possibilities on how to manage those trades. And in the case of non-directional trades, you just need to keep in mind that you need to stay, beyond 1 week. I mean, the beauty of doing a 1 week iron condor is that the speed of time decay is massive. So if things go well, it's beautiful. The downside of doing an iron condor, which is less than a week, is that that's it. You're right or wrong. Okay, unless you got an increase of volatility, a very important increase of volatility during the week, when you try to do the tweaks, it's not going to work too well. Okay, and I will add one last comment. Okay, for the ones of you that do like the 1 week. Okay, I will add one last comment, which is a classical technique that many traders use as well. Is that, let's say you do an iron condor for a week, and you sell it for 112, or let's say 100, just to pick a round number. So then many traders out there, same for credit spreads, they place an order to buy to close at half of it. In this case, it would be 50 cents. So you do your iron condor at $1. You are ready to buy to close at 50 cents. And because the speed of time decay is very fast during that 1 week, so maybe 2 days after, you are able to close the iron condor. As long as the stock hasn't moved too much, you are able to close the iron condor at 50 cents. and then you are out of risk, and you're also out of needs for tweaking because you are out of the trade, 2 days, 3 days after. So you're not there on Friday. Okay. Now, of course, your reward to risk ratio of the trade is gonna be hurt. Already Aaron Condor starts with a disadvantageous reward to risk ratio, where the probability is good, the reward to risk ratio is not so good. So if you're gonna close your Aaron Condors for half of the premium, so then your profit is gonna be half. And again, now your probability of winning is going to be much higher. So again, it's all a matter on how you execute it and your trading plan and your preferences and so on. But again, nothing wrong with doing the 50% premium to buy back. Nothing wrong with doing 1 week instead of 2 weeks or 1 month or 2 months. But again, everything got pros and cons, and I'm just mentioning all of this so you guys understand your choices, because options give you options. So you know what's suiting your personality as a trader better. Okay, cool. Okay, so what I'm gonna do then is I'm just gonna delete the rows with Facebook, and we are gonna start now looking for trading opportunities. Okay, so interestingly enough, for whatever reason, not sure why is that. Yeah, I cannot. Okay, I'll need to manage this later on. I have a mini problem with my keyboard at this moment in time, so I cannot delete that row. Anyway, I'll do that at another time. Congratulations, Marks. Yes, I'm seeing that message there at this moment in time. Yeah, thank you so much as well to you, Christian, for that. So let's begin our analysis. Okay, let's begin our analysis. We're gonna be looking for opportunities with high implied volatility. We're gonna be looking for Aaron Condors. I'm gonna start filtering using the mean, the CIV mean greater than 80, and nothing else. We don't want anything that has to do with strength of sectors or industries. I'm gonna load my typical list with penny increment options. We are gonna set up daily and weekly neutral strength for the stocks that we are looking for. We'll be looking for at least 15 days before the next earning report, and auto climate will want all to be unchecked. And with all of this, we're gonna scan and see what we find. Okay, and so far we found a couple of opportunities. Okay, so I'm just gonna start with the first one in the list, which is Fedex. So let's go ahead and take a look at Fedex and see where we would be. Okay, so I'm gonna say probably not a good idea, even though this is not very common. So Fedex reported earnings yesterday after the close. Today, Fedex gapped up by 6.5%. Typically, when that happens, when the markets go up, typically volatility goes down, and typically when earnings are reported after, volatility goes down as well. And in this case, we can see volatility did go down, but based on the scanner of the matrix, okay, it's still above the 80 percentile for that stock. So doing an underdirectional trade could make sense. Okay, in any case, I'm gonna look at other opportunities. It's not like we have too many at the moment, so I may come back to Fedex, but I'm gonna look at General Motors, because if earnings didn't happen yet, okay, earnings will happen on February 9, as you can see. So notice how the implied volatility is still pointing up instead of Fedex that was pointing down at 32. Okay, so now with General Motors, let me understand where we're at. So all-time high is really close. Okay, all-time high is very, very close. So this is all-time high. Okay, but it seems that based on the cone, we will not be reaching all-time high until somewhere around January 14. Okay, January 14. So we can do an Aaron Condor, potentially, assuming we have UFOs and everything else we need, we can do an Aaron Condor here of maximum 1 month's time. Okay, so January 14, it's the furthest I will go, because you could go all the way to that expiration date here. Okay, January 28 because earnings are coming in February, but January 28 would give us statistics suggesting that we may get to this price point where all-time high is here. So then there's no way we're gonna have those defensive UFOs somewhere in here. Okay, that's why I'm setting a limit using January 14. Okay, so let's go ahead and float a spread select window here with General Motors. We are gonna be looking at short iron condors. Here we go. We're gonna be looking at January 14, 7, 31, and 23. Normally, what I would do is to look at the skew to see which one is best. So 17, it's over, 23, 31, 7, and 14. Okay, those are the ones that we're going to use. And it looks like, okay, it looks like the distribution, there is not too many prices anomalies here. It looks pretty neat, very like a book volatility smile, if you wish. Indeed, the December 23 carries more volatility, as you can see. That's normal. But then what's not normal is that December 31st, it's very low, where green color, January 7, is higher. Okay, so normally the green line would go below the blue line or something like that. But in this case, it seems that there is a little bit of extra volatility on January 7. Okay, so what I'm going to do then, just to give myself a bit more odds, is uncheck December 31st. Okay, and I'm going to be focusing on 23 of December and then January 7 and January 14 and see if those are valid combinations for the trade. The minimum strike price increment for that stock, which is $56 per share, is 50 cents. But I'm going to start with 1 because typically 50 cents, they may end up having a little bit more slippage built in. And also because that stock is $56. So I'm okay to risk up to $200 per contract. So 1 to 2, that's going to be my selection. Christian, headline risk, stock tank, because a key manager left abruptly. No one knows what it means. No comments from General Motor. So I'm not sure any mechanical approach works when investors change their mind. Yeah, I get you. At the same time, if you believe in efficient market theory, that will be priced in, and that's why General Motors got high implied volatility. So if that was not to happen, then you will not get that level of implied volatility. So if that or whatever else is happening, now you get that implied volatility. So as long as all the rules work and we have a defined risk, which we do with Iron Condor, even if the stock was to go bankrupt tomorrow, the most you would lose is pretty fine, isn't it? So then I have no problem. Okay, I am a technical trader, okay, and it's okay if not everybody is, but being a technical trader, I have no problem just ignoring that instead of now being biased and maybe not taking the trade because I get a concern and then I miss my profit. I prefer to expose myself to the risk in a way where the risk is under control because I am seeking risk because risk equal reward. I just want to make sure my risk is under control. And the event is generating more implied volatility, which typically would imply greater premiums with a distance between $1 to $2 between my strikes would create a risk of maximum $200 per contract. So even if the world is ending, I'll be happy to take a trade with $200 of contract, $200 of risk, especially if we're in a situation where implied volatility is higher because of something crazy is happening out there in the world, in this case to General Motors. Okay, so that was my long way to answer. I don't care. Hopefully this makes sense, Christian. Again, those things normally are priced in, and that's the beauty of options trading, right? If you were to go long or short the stock because of the news, you may be right, you may be wrong, but here you have an offset, which is the extra premium built in the options when those things happen. Okay, cool. So let's go for it. Let's activate our filters. Let's go ahead and load our template for Iron Condor. Click OK, and we're gonna build 99 combinations. And now we're gonna filter this and see if anything passes. And yes, we have multiple passes, starting with December 23, with 58, 59, 58. So let's take a look at December 23, which is right here. So that would not work, okay? Because December 23 is showing 60 and 52, okay, as statistical prices, statistical range, 60 and 52. And in this case, we can see the maximum we got is 59, which that is not good. It's not good enough. It needs to be beyond, okay? So I'm gonna uncheck December 23, and therefore we're gonna be trying this trade with the other two expiration days left. The next one is going to be January 7. We got many passes here with January 7. Okay, so we'll see all the way to here. Okay, so we got all the way to 65 and 50, something like that. So let's take a look at January 7, which is right here. Here we go. So we are looking at the blue line, okay, the light blue line, and this is 60, 64 and 48 something, okay? So 64 and 48 something. So that 65 is good, and we got 48 something. Oh, but that one fails, okay? 65 and 50, no good. No good, okay? Almost, but it's not good. So we're gonna go ahead and check the last one, January 14, and see if this one works. Okay, see if this one works. Okay, so we are talking about with January 14, we are talking about 65 and 47, okay? 65 and 47, those would be the values. So 65, 49, no good. 65, 49, no good. 66, 49, we're not gonna take that. 67, 49, no. 65 and 50, no. 67 and 50, no. 65 and 50, no. And then we now come into the fail territory. Okay, so it seems that General Motors is not giving us an opportunity. It's quite tight, almost, but it didn't. Okay, so then we are going to continue. Okay, and again, in the back of my mind, I'm thinking we also have Fedex. Okay, notice how General Motors now went away. I'm not sure what that is. Okay, but maybe, okay, it may be that the implied volatility is dropping, and therefore it's not good enough anymore for the matrix to return it. Okay, but in any case, while we can always go back to Fedex and look at it more in depth, I also want to look at what if instead of checking volatility using technique number 1, which is mean greater than 80, what if I look at mean minus historic volatility above 2 standard deviations? That's another technique. Okay, and that is now giving me 2 different possibilities. Okay, so let's take a look at ADM and see if that would work or not. This looks like a very massive, yeah, and the problem is that this is also all-time high for ADM. Pretty massive amount of implied volatility compared to historic. As you can see, the red line is so far away from the blue, so that's great. But the problem is that that thing here is all-time high, and even if we use the next expiration date, already statistics suggest we're gonna surpass that. So yeah, so that one would not work given the technicals. And the next one, SRPT. Not sure about how liquid those options are going to be in that particular case. So the monthly time frame shows all-time high is very high up here at 180. It's currently trading at 86. Okay, So then in that sense, from a technical point of view, I'm delighted. I'm pretty positive we should be able to find a good combination. Now, from a liquidity point of view, I have not traded that particular stock. So before we continue, I would like to look at the option chain a little bit. It's not too bad, actually. No, it's terrible. 165 to 330, 135 to 205. That's way too wide as a beta spread. So I'm just going to skip it, okay? Even though it's one of the stocks I have in my penny increment list. In this case, it's not liquid enough, okay, for me to accept. So third technique on how to find options that are overpriced is to look at top percentage increase in the last 5 days for the CIV min. And when I do that, I should get other stock symbols here. It's taking longer than normal. Not sure why is that. Okay, now. So now this gives me many choices, okay? And this is kind of like what normally happens. This is the technique which is the most kind of like the most generous when it comes to giving you choices. So we're gonna start with Starbucks. Starbucks, which is falling very hard, 3.6%. That's nice. Earnings happening on January 25, so we can use multiple expiration dates. So let's take a look at Starbucks right here. Yeah, and I forgot to link it. So let me link it so for next time I don't have to type it. Okay, so we said this is all the way January 21st. Okay, so I'm okay to use 14. Yeah, so the same I had. Okay, so with Starbucks, we can see how the red, which is next week, it's more inflated. But then the next one in line is the blue. Okay, and then the other ones come, like normal. Okay, so there is no surprise, no price anomaly here that we can see visibly. All looks quite normal. So in that sense, we're just gonna have to apply the process to Starbucks with the spread select. Let me load Starbucks. Okay, and we're gonna do this for 23, 31, 7, and 14. Okay, so in this case, we're gonna check 4 different expiration dates. This is a $100 stock, so I'm gonna do 1, 1 to 3. That should be good. Okay, and we're gonna start building the spreads that we wanna build, and we're gonna sort this and see what is it that passes. So we got a bunch of passes for 23 of December, which is 1 week to go. We talked about the pros and the cons of 1 week to go earlier, isn't it? So now if we look at 1223, the blue line is showing 113 to 105. Okay, 113 to 105. Those are the 2 values that we are looking at, 113 to 105. So what do we have that? 113 to 105. Okay, so this one passes. 113 to 105. 113 to 105.75. Yeah, so this one seems to be the best choice. So let me graph it. Okay, let me graph it and see what is it that we have. So liquid options with Starbucks, 21 cents, break-even points, 113.22, 104.70 something. So this matches what we need. So I'm gonna keep it here, but also just so we can play a little bit with different expiration dates into the future practices that we'll do in the sessions. And also because I understand some of you didn't fully appreciate those 1 week Aaron condors. So I'm going to look into other expiration dates as well. okay, to see if we can find something that is better or not. Okay, here we go. So we got December 31st, a bunch of December 31st. So with December 31st, which is here, so we'd be dealing with 116 to 102, 102, almost 103. So 116, 102. So 116, 116, no 116 so far. And this is January 7, okay? So that one doesn't work, okay? December 31st does not work. And then January 7. Okay, so let's start again. With January 7, we have a few. And that would be here, January 7. So we have 117.5, 101, okay? So 117.5, 101. So 117, 117, no, 116, 116, and then we get into 117, but this is January 14, as you can see here on the left, okay? So January 7 does not provide enough premium, therefore it's time to check the last expression data available, and if not, what we found is a 1 week iron condor, so we'll take that one. So with January 14, right there, so we are looking at 118, almost 119, and 100, okay? So 119 and 100, so we got 120, okay? We got 120 and we got 96, okay? And now I'm a bit uncomfortable here because while Starbucks is a pretty liquid company, notice the bid 29, the ask 162, so this may not be doable, okay? But anyway, 121, 196. Same story, 21 cent, 102. Wait a moment, I actually forgot what I said. 119, correct, 119. So 120. Yeah, I'm seeing some of those strikes, 29 cents, 162. I am not confident we're gonna be able to execute that properly. Yeah, 29, 162. So that 120 strike, for whatever reason, even though there is some volume, 2 contracts were traded, really there is no good markets. Okay, so my friends, we are just gonna leave it there with Starbucks. We're gonna do the other trade that we planned. Okay, it's gonna be a 1 week iron condor. Okay, and that is assuming that the chart now will approve the trade, right? So let's go ahead and do our drawing. So again, we're gonna be using December 23. Okay, so this is a Santa Claus iron condor. Here it is, from here to here. Okay, so this is the statistical range, okay, where that market should be trading, within. I'm now changing to the 55-minute time frame to find the UFOs, because we need UFOs with 48% probability at least. We got 51, that's good. And then we need at least 2 UFOs to defend ourselves. Okay, so yeah, here on the upper part, indeed, we have multiple UFOs that could be very useful to defend ourselves. Okay, actually, let's say we have 3. They're very near to each other, so this is going to be the upper part of the iron condor range. And if we look at the bottom part, okay, so we have 1 and 2. Okay, so I could go as near as here. I could go as near as here. I'm not in love of, when it comes to going that near, especially because here there is more distance. And if I go to this one, that one seems to be much further away, isn't it? So let me take a look at what happens if I switch time frame to see if I can uncover other pockets of unfilled orders and rely on them. Remember, we are just looking for UFOs that slow down price, create a little bit of a bounce. We are not looking at catching a turning point. This is not a directional trade, isn't it? So yeah, with the 89, there is nothing. With the 144, take a sip of water, guys. With the 144, yeah, it's further down. With the 233, okay, it's downloading data. Yeah, same location for those UFOs and the 377. So this is the last one I'm gonna check going up, and the next one I'm gonna check is going down. So okay, so we started with 55, so I'm gonna go down to 34. So if we look at 34, here we go. So this is kind of like what I was looking for. Okay, so if I place my line there, okay, that's perfect. Okay, that creates a setup where price is more or less in the middle. Okay, the amount of space between red and purple is quite similar, and therefore now if I go back to the daily time frame and I zoom in, okay, so the only thing we need to happen for us to profit is for the price of that stock to stay in the purple area, which is between the red lines. If that stock behaves, a bit naughty, if you wish, and tries to break away from that purple area, we have a collection of red UFOs above, which may bring it back down, and we have a collection of green UFOs below, not like that, like this, that may bring it back up. And again, in the end, that stock ends up somewhere in the purple area, which is the profit zone. So all of this is looking fine. And therefore, in order for us to place this trade, we need to go back to the risk graph. So again, we are looking at collecting 19 cents. It was 21 before. So we lost a little bit of premium there. And the maximum risk of the trade would be $80.50 per contract. The maximum profit would be 19 to 19.5 cents, depending on how much you get filled at. And right now it's 20. So that's the risk per contract. Okay, so keep that in mind in order to position yourself properly. Maybe you do this trade with one contract, maybe you do it with 5 contracts. All of this depends on how many times you want to risk 80. Every contract would carry a risk of 80. Okay, in this case, assuming you get filled at 20. Okay, so let's go ahead and place the order. Okay, let's place the order. So we're gonna move to Starbucks. We are looking at December 23. We are going to be selling an Iron Condor, and starting with the call side. So with the call side, we're buying 114, selling 113. Okay, so buying 114, selling 113. Okay, and on the put side, 114, 113. On the put side, 105, 104. So 105 and 104, and this is producing a credit of 21 at this moment in time as we speak. Okay, so I'm just gonna place an order for this. I may not get 21. I may need to change the price. Let's see. Real-time price is more like 20. Now, actually, now it's 21. Okay, just to make sure I get filled, I would say you guys try 21. Be patient there for a little bit. If you get filled, let us know on the chat box so we all know. I'm just gonna go for 20 just to make sure I got this filled, and then in the following sessions we can work on this trade like we always do. Okay, so I'm gonna try 20 and see if that helps with the fill. I'm not sure why this one says working. This one should be gone. I guess it's a little glitch in the simulated account. Let me do it again. You guys be a bit more patient. Okay, it's showing the mark is 22 now. So I'm trying the 19 to see if I get filled, okay? Okay, so I guess it's a bit challenging. 21, 19. Okay, I'm just gonna try 18, just so I have it. Again, you guys, don't rush. Okay, so this is looking like there is an issue on the simulated account here. As you can see, it's almost like this initial order got stuck because this is trading at 21.5 now. 18 was actually the bid price. I should get filled for sure. So let me go ahead and, yeah, that one I can cancel, but that one I cannot cancel and replace. So, okay, so I guess I'm gonna have to keep trying to get the fill here. And I'm just gonna go extreme to, let's say, 15, just to see if I get the fill or not. And if I don't get the fill now, I will conclude the demo account got stuck, and then I won't be able to get the fill, which is unfortunate. And it looks like this is what happened because I got 15 there, 21 here. I should be filled for sure. The real time price is actually 15. So for sure, I should be able to have that executed, okay? So anyway, so not ideal, but you know what? We can still learn from this. I'm just gonna copy this trade and I'm gonna put it on in top. Okay, I'm gonna put it in the positions panel. So we'll be able to go back and review this at a future time, okay? Cool, so we are 8 minutes to go. Okay, we are 8 minutes to go. Let me also draw a line, horizontal line where we entered, which was more or less here. Okay, and now from a management point of view, okay, from a management point of view, of course, if that stock starts rallying, right? So these statistical measurements on where the price should stay within, okay, which are those probability cone or probability envelope lines. So they may, okay, sorry for that, they may surpass that purple area, purple line. So if they surpass the purple line, then you know you have to tweak. Okay. So again, I will not repeat the whole thing because we talked about it last week, but you know, I'll mention it one last time just because we won't meet until next Wednesday in case something needs to be done on Monday, Tuesday, something like that. So I'm failing to say something here that I was thinking about that I don't want to miss to share with you guys. So all of you are safe. Yeah, I know what I was going to say. So the one thing I was going to say is that we already seen the disadvantage of doing a short-term iron condor. Again, the advantages are also there, so the pros and cons. But again, when it comes to tweaking, just keep that in mind. If Starbucks was to crash heavily or rally heavily, and very quickly, like I say on Monday, you have your probability lines crossing the purple line here, and you need to do a tweak on Monday, maybe Tuesday, so then it may work. It may help to do the tweak because it's happening, you know, far from the expiration date on the 23rd. But if, let's say, like in the case of Facebook, it's happening kind of like almost like in the second part of the week, so it's just like it's not going to work, right? So you're just going to have to leave it alone if you want to do the same thing I did with Facebook and basically rely on those UFOs to bring price back into the purple zone. Okay, just keep that in mind. Okay, so watch it carefully, guys. And again, this is an iron condor, which typically is quite passive, but if you are doing it with a 1 week to go, it's actually an active way to do iron condors, and therefore make sure you review this trade daily so you can be on top of it. Cool. So we are 5 minutes to go. Let me see. We won't have time to put another trade in place, obviously with 5 minutes. But you guys, what about you? You tell me, how is it going out there? Um, how was the plan for this trade? Is all understood? Yes, no questions. And if there is nothing for you to share because it's all good, just type OK. So I know it's all good, but I'd like to get that feedback from you guys before we conclude. Just gonna try to get this down one more time to see if I get filled. Yeah, so you can see here that this simulated account got stuck. Something got stuck. Let me try again by canceling. Okay, so we're gonna buy the 114. We are gonna sell the 113. And then we were doing what else? 114, 113, 105, 104. 105 and 104. And that shows us 22. I'll try again with 20, see if I get it. Okay, it's there. Let's see what happens. How many bars do I have with the probability cone? Yes, right here. So right click, edit study, probability cone. Probably the best if you want to take a screenshot. But basically, I am looking at 21, 42, and 63, which is 1 month, 2 months, and 3 months for historic volatility. And then I'm looking at continuous implied volatility. Okay, and then for everything, I'm looking at one standard deviation, which is 68.2689. Okay, that's what it is. Yes, Mark, absolutely. Email me, my friend. Yeah, very cool. Okay, so it looks like I don't see any more questions, any more comments. So I'm guessing that it's all clear. So it was pretty straightforward session today, I would say. A little bit of market analysis. We reviewed the trades, which was a little bit of repeat of things that we discussed the other week, but now we saw the end of the story. And today we find another encounter, which is almost copy paste from the one with Facebook that we had the other week. So hopefully the session today it's helping to solidify the process on, especially on how to put together an Aaron condor. And we'll keep going, guys. So I will see you on Sunday in our top session, where we're talking about top. And often, apart from talking about top, we also talk about trading, isn't it? So it goes hand in hand. And the one after then will be back to normal on Wednesday, guys. Very nice, everybody. You guys take care and see you soon. See you on Sunday with the top session. Take care, everybody. Bye bye.